that is you can actually find the pre-built search for the current month or the next month. You can look for options that are both in the money, out of the money, or both. Folks, for the purpose of this class, I'm going to probably encourage you folks to start looking at the current month pre-built search. That's where I'd probably encourage you to do. If you're working with your coaches, you may also want to start looking at the next month. But these are the two buttons, the current month and the next month. Those are the two areas that you'll be probably spending most of your time with. After you become more and more experienced with this, you can literally build your own custom search. You can say, all right, I want stocks, really solid stocks, good stocks, that I can make 15% over the next 10 days. Well, you may not find a whole lot of stocks like that, but you could build that search if you want, okay? You can then go, trim down your criteria, you can sort them, and you can run what's called a custom report. I would begin here with the pre-built and custom searches. Again, as your experience, you have more experience, then go ahead and build your own custom search. You can also go to your own buy watch list. Remember, we found our buy watch list because we understand the turbo search. We've done the turbo search. We have our watch list, maybe 15 to 20, maybe 30 candidates, if you will. There's our watch list. We have eBay on here, Taro Pharmaceuticals, Ultra Pete. You'll see the trend of most of these are heading up. Those would be great candidates for a covered call. eBay right over here, let's use eBay as an example. eBay's trending up. Let's blow that up there. The last trade is $56.93. Market Guides Axe, 3.50. Phase 1, 5.3. And we have some 3 green arrows. Well, that's a great opportunity. Let's take a look at this trade, actually. Your own buy watch list, the stock's at $56.93. Okay, fine. We could have the option to go ahead or the choice to sell somebody the right to buy the stock from us at 55 or the right to buy the stock from us at 60. What determines that? Well, what ideally determines that is your outlook, of course. A bullish outlook, you would choose the $60 strike price. A bearish to neutral outlook, choose the $55 strike price. Again, when I say bearish, keep in mind we're mainly not going to be doing this on bearish stocks. If we own the stock or we're looking at the stock, we can make a really solid rate of return. If the stock moves up or down $1, $2, whatever, that's fine. Well, in this case, the stock's very bullish. I like the stock. I'm going to go ahead and investigate selling a $60 covered call. So again, we own the stock or we're going to buy the stock at $56.93 and we're going to sell somebody else the right to buy the stock from us at a higher price than we paid. Let's take a look. Covered call calculator. The 500 shares at $56.93. We're going to sell the $60 strike price. The premium we'll get for that, $1.55. Again, that's 6 weeks to expiration. The price at expiration in this case was $60. So we're actually going to get called out. We're going to get the rate of return from the $56.93 all the way to the $60, and we're also going to get the $1.55. Well, go over here, click on this little calculate button, go over here to no margin. Let's just start with no margin. That's where you'll be in your retirement accounts, your IRA accounts. There's no margin available there. I trade with margin. I'm comfortable with that. Let's take a look. The $28,000 for this trade, your total income is $775. There's your total investment. In this case, it says total return if called out, $2,310. Maybe not great, not bad, but let's take a look at the rate of return. Take a look at this graph right over here. It says your rate of return is 8% for 6 weeks. 8% in 6 weeks, not bad. This is considering, though, that the stock moves up. Now, class, I say this is not bad, but again, I've been doing this for years. Let's be realistic. Some of you folks have met with your financial planners before. Maybe you've done your financial model on what you can make on money. Well, what do financial planners do when they say, how much money can you make? They say, what? You can make usually, 15, 20% a year, no problem? Class, yes or no? No, they do it what? Between maybe 6% all the way up to, what do you think? Throw out some numbers. 6% all the way up to what? 8, 12 sometimes? Maybe 8 to 12, okay. So maybe 6% all the way up to 8 or 10%, and that's on a monthly basis or no? No, that's on an annual basis, right? And let's be real. What are they doing with their money? Are they trading it, looking it over every single day, making it grow? Probably not, right? They're going to put it into maybe an index mutual fund, something like that. Or maybe they don't really know. Maybe they take the recommendations. This is, by the way, common. They take the recommendations that they were told to go ahead and invest in, and they just put their money there, okay? Again, nobody cares more about your money than you. So that said, making 8% a month, or again, cut it in half, 4% a month on a sideways stock, that's very good. What are you going to need to give? I talked about this previously on my stock day. What do you need to give? You're going to have to give some sweat. You're here today. You have to review these DVDs. You're going to have to give it a little blood, sweat, and tears. Ladies and gentlemen, it's the way it is. If you've been doing it this way right now and it's not working, you better do something else, all right? That said, it's the leverage of financial education that has been very, very profitable for a lot of our students. Only buy stocks you like with neutral or bullish outlooks. Strong fundamentals, of course. Look for stocks priced in the $50 or less for optimum returns. Sell out of the money calls when bullish. Sell at the money or in the money calls when bearish. Shoot for a 5% monthly or a 10% if you use margin, and use mental stops on stocks for downside. Now that said, mental stops on stocks for downside. I'm not a big, huge fan of mental stops, all right? Because does that sound like it could be potentially emotional? Yes? The stock goes down and, I was going to say it's $30 stock, goes down to 27. No, well, I was going to sell at 27, but no, I'll go to 20. You can just open yourself up. So now that said, I would encourage you to have a line in the sand that you have agreed either with your trading partner, maybe your spouse, whoever it may be. Say, hey, honey, or business partner, whoever it may be, hey, we're out at 27. That's it. I'm writing it down. That was my trading plan with you. Now, I'm going to tell you about a little area here that I've been very, very profitable with. It's kind of a little bit off the beaten path here. And we talk about it right here. It says, sell at the money or in the money calls when bearish. The at the money call is always the most profitable option to sell. Why? It has the highest volatility. It's usually the most overvalued. Remember from our session on overvalue, undervalued, ideally we sell the at the money call. So if you can find a stock that is at the money, for example, if you can find a $17.40 stock, and you sell the $17.50 option, whammo, you're going to get paid, all right? Because it's right there at the money. Now that said, I have made a literal career out of selling in the money covered calls. At first glance, it's going to be a bit boring for you. But as you progress and you begin with your accounts from 5,000 all the way up to 100,000, all the way up to 100 million, and upward from there, all right, these in the money covered calls are very, very comforting. And they've proven to be very, very effective. Now let me tell you a little bit about what that is. Let's say you own the stock. Let's use a small stock. Let's say you own the stock at $16 a share, okay? XYZ stock at $16 a share. Well, if you're bullish on the stock, ideally you'd sell a $17.50 covered call. However, in this circumstance, I know a lot of you folks who are watching these DVDs at home, and a lot of you folks who are getting coached, not only, yes, you're interested in cash flow, but aren't you also interested in capital preservation? Ladies and gentlemen, yes or no? Are you interested in that? Yes or no? Yeah, absolutely. Well, if you're interested in capital preservation, if you own the stock at $16 a share, yeah, if you're bullish, that would be nice. But wait a second. You could actually, instead of selling the $17.50, you could sell the in the money covered call, the $15 covered call. And they may pay you like $1.75. That would be about average for something like this. So let's think about this. You own a $16 stock. You're selling somebody else the right to buy the stock from you at $15. That means if it's at $15, $16, or $17 a share, will they buy the stock from you? Class, yes or no? Yeah. And if it's above 15, 16, or 17, they'll buy the stock from you at what price? If you sold the 15, they'll buy the stock from you at what price? 15. So let's see. If you own the stock at 16, they pay you $1.75 for the ability to buy the stock from you at 15, and you sell it at 15. 15 plus $1.75 is just like you sold the stock at $16.75. Are you with me on that fast math, right? $1.75 plus 15. So just think. Now, as you progress in your knowledge, just think. You own the stock at $16 a share if it goes up. Class, if it goes up to $16, $17, $18 a share, do you make money? Yeah. If it stays perfectly flat at $16 a share, do you make money? Yeah. If it goes down maybe, about 5%, is it possible for a stock to go down 5%? It's probable. Yeah, it can happen. If it goes down 5% down to, 15, 20, can you make money? Well, let me see. If it's above 15, you make money. Every single month, you can use the in-the-money covered call strategy to make great cash flow. In fact, that's how I love to work my bigger accounts. I have several accounts. Bigger accounts, I'll own great assets, great stocks, and not be overly bullish. I'll just make money on time decay. So when I get up in the morning, put my feet flat on the ground, I look at the alarm clock, say Shazam, say what a fabulous day filled with love, opportunity, and potential, and realize, hey, I'm making money because time is decaying. Why wouldn't you do this? I don't know. Again, that your broker hasn't told you this. Why did Warren Buffett use these type strategies in the 70s and 80s? Because he knew about them. All right? You're welcome to higher rates of return using leverage and selling time. Once you become a little bit more experienced with this, you can actually make fantastic rates of return selling covered calls on stocks you don't own. It's not called covered calls, they're called uncovered calls. Now just, again, if you will, borrow from the future of this conversation a few months from now. You've gone ahead and you've been a student of our system. You've learned A to Z what it's needed as far as our stock course is concerned. Well, great job. You've gone through the mentoring and the coaching that's required there. And now you've progressed here to the options. You're looking forward to your options coaching, but your mind is slowly becoming opening to new opportunities. And just let's take a look at this one opportunity of selling in the money covered calls. In fact, many times as you become more comfortable with volatility, and let me go back to that volatility because that is actually helping me sell covered calls. Remember, volatility is what really makes that option expensive. Do you remember that? Let me go over that a little bit. The historical volatility, we know that for a fact. That's the average volatility versus the implied volatility. That's very expensive. That's the future. Once you're comfortable with those ideas, I just explained them, so you're probably not right now. As you become more and more comfortable with volatility, you'll realize that it is very, very profitable to sell expensive volatility. So when options and stocks are very, very, mainly options, when they become more and more volatile, you'll realize that they're no longer very profitable or conducive to buying, but they're very conducive to selling. Now that said, let's apply that to what I've just discussed as far as in-the-money covered calls. There are even websites devoted to this. In fact, I've subscribed to a few of them over the years. We have found stocks that are fairly inexpensive stocks. We're talking $5 to maybe $15 stocks, maybe a little bit more than that, but in a more inexpensive price range. All of the things considering all of the things equal. Let's just say it's a $9 stock. Well, let me do a different example. An $8 stock. We just found this example recently on the website. An $8 stock. We did this example on you can write your own search to do this. Okay, an $8 stock. And expiration is literally a week and a half away. A week and a half away. Stock doesn't do a whole lot. It moves up and down anywhere between about $7.40 all the way up to $9. Doesn't do a whole lot, but all of a sudden it's at $8 a share, and instead of selling the $10 covered call, you could easily sell the in-the-money covered call for a week and a half. Well, remember, it's $2.50 increments. Remember that? So we have about a $8 stock, $7.50 covered call on good news. So now, again, take a listen to this. The stock bounces between about $7.40 a share on about $9 a share, and it's at $8. And we have green arrows and good news. On one day, you go ahead and you own the stock. So you buy the stock at $8 a share. The very next day, the stock goes up about 20 or 30 cents. Is an $8 stock, is that possible for it to go up 20 or 30 cents? Yes or no? What do you think, guys? Yeah, absolutely. So then when it goes up just a little bit, what happens to all the calls? They all go up, and all of a sudden, you are now selling an inflated or an expensive call. So this can happen literally in a day. You find a great stock, it's $8. It then goes up to, say, $8.25, and then you go back, you look at the options, and you could sell a $7.50 option for, maybe $1, maybe a little bit more than that, $1.20. And without going over the math quickly, I don't want to go over the math. The math is not important. The key thing is to understand is a trade like that can make you sometimes, 3 to sometimes 9%, depending on the stock, within a week and a half. And what's your risk? Let me think again. Let me go back over the same example. If you own the stock at $8, it goes up to $8.20, you're selling somebody else the right to buy it from $7.50. As long as it closes $7.50 and above, do you make money? You're good to go. So again, really explore that. Really understand those concepts and explore that a little bit because it has been used for years and years and years. literally, there's funds and hedge funds, and people are aware of this concept. They've used it for a long, long time. Now, then that said, some of you folks like myself, you didn't have the capital to even buy some of these stocks. They're just too darn expensive, all right? Therefore, our next section, what we're going to start talking about is a little bit about leaps, all right? Let me go ahead and introduce a leap here to you so you know what it is, and we're going to use that in our next section. A leap. A leap is what's termed a long-term equity anticipation security. What a leap is basically a long-term option. It can expire any time between, usually about 7 months from now all the way up to 2.5 years from now. But here's the key to understand, and kind of tempt your tummy for our next section, is that one contract, as long as you can forecast the growth of a stock over, let's say, a year. Friends, do you think you can use our system to forecast the growth of a stock over 12 or maybe 18 months? Class, yes or no? What do you think? Yeah. So once you become accustomed to that, instead of buying a $30,000 or $50,000 stock, you could literally spend just a few $1,000s on a leap. That, combined with the section after that, we are then going to discuss stock splits. And then we're going to marry that with our last section of the day, which is exchange-traded funds. So let me summarize. What we've brought you through here so far in this section is our covered calls. We've talked a lot about covered calls, and they can be used extensively. I'm going to encourage you to become very, very aware of how we can use covered calls, especially the in-the-money covered calls. Not the most aggressive thing you'll do, but a very, very profitable thing. And why I say that, again, is those daily, weekly, monthly profits, they'll boost your confidence. We're then going to go over A to Z about leaps, probably one of my favorite sections, okay? We're going to talk about an aggressive strategy called called stock splits, very aggressive, and then our exchange-traded funds, all right? We'll look forward to that next section.